North Star VFD Consultancy welcome you to another video on Introduction to International Financial Reporting Standards, IFRS. This video is part 2 of IAS2, Inventories. In our earlier video, part 1 of IAS2 Inventories, we discussed history of IAS2, objectives of IAS2, important terminology and definitions, scope and scope limitations, measurement, and cost of inventory. In this video, part 2 of IAS2 Inventories, we are going to discuss inventory cost formula, cost of specifically identifiable goods and service, cost of inventory not specifically identifiable, that is methods such as FIFO, weighted average cost. Then net realizable value of inventory, write-down of inventory value, reversal of write-down of inventory, recognition of inventory cost as expense. Finally, we look into inventory-related disclosure to be presented in financial reports, according to IAS2. Before beginning, let me introduce you North Star VFD Consultancy, a professional financial management consultancy that provides services of accounting and tax management, financial planning and analysis, budgeting, cash flow, financial reporting, internal audit. For more information, please visit our website www.northstarvfd.com. Cost formulas. Cost formula for the cost of inventories of items that are not ordinarily interchangeable. The cost of inventories of items that are not ordinarily interchangeable, and goods or services produced and segregated for specific projects shall be assigned by using specific identification of their individual costs. Specific identification of cost means that specific costs are attributed to identified items of inventory. In practice, this is a relatively very difficult method of valuation, as the effort required does not make it feasible unless there are relatively few high-value items being bought or produced. Consequently, this method is inappropriate where there are large numbers of items that are interchangeable. A specific identification of costs could distort the profit or loss arising from these inventories through the method applied to selecting items that remain in inventories. Cost formula for the cost of inventories of items that are ordinarily interchangeable. The cost of inventories of items that are ordinarily interchangeable shall be assigned by using the first in, first out, FIFO, or weighted average cost formula. Where it is necessary to use a cost flow assumption, i.e. when there are large numbers of ordinarily interchangeable items, IAS2 allows either a FIFO, first in, first out, or a weighted average cost formula to be used. In the vast majority of businesses, it will not be practicable to keep track of the cost of identical items of inventory on an individual unit basis. Nevertheless, it is desirable to approximate to the actual physical flows as far as possible. The FIFO method probably gives the closest approximation to actual cost flows, since it is assumed that when inventories are sold or used in a production process, the oldest are sold or used first. Consequently, the balance of inventory on hand at any point represents the most recent purchases or production. Under the weighted average cost formula, the cost of each item is determined from the weighted average of the cost of similar items at the beginning of a period and the cost of similar items purchased or produced during the period. The average may be calculated on a periodic basis, or as each additional shipment is received, depending upon the circumstances of the entity. The weighted average method, which like FIFO is suitable where inventory units are identical or nearly identical, involves the computation of an average unit cost by dividing the total cost of units by the number of units. The average unit cost then has to be revised with every receipt of inventory, or alternatively at the end of predetermined periods. In practice, weighted average systems are widely used in packaged inventory systems that are computer-controlled, although its results are not very different from FIFO in times of relatively low inflation, or where inventory turnover is relatively quick. LIFO, last in first out. LIFO, as its name suggests, is the opposite of FIFO and assumes that the most recent purchases or production are used first. In certain cases, this could represent the physical flow of inventory, example, if a store is filled and emptied from the top. However, LIFO is not an acceptable method under IAS2. An entity shall use the same cost formula for all inventories having a similar nature and use to the entity. For inventories with a different nature or use, different cost formulas may be justified. Cost formula, FIFO method illustration. Earlier we learned various cost formulas prescribed by IAS2. First cost formula, related to the cost of inventories of items that are not ordinarily interchangeable, and goods or services produced and segregated for specific projects shall be assigned by using specific identification of their individual costs. Then we learned that, the cost of inventories of items that are ordinarily interchangeable, shall be assigned by using the first in, first out, FIFO, or weighted average cost formula. Now let us look into an illustration to understand better how cost is computed under FIFO method in real-world situation. Here in the screen you can see the data related to an inventory item, its opening balance, purchase and sales of etc. at various dates. Opening balance as on 1st January was 30 units at the rate of $3 per unit. Subsequently, on the 7th of January 20 units are sold, since cost of first available unit being $3. The unit cost of sold item is assigned is $3. On the 18th of January, further purchase of 40 units of same inventory item at the rate of $4. Again on the 22nd of February, another purchase of 20 quantity of same item at the unit rate of $5. On the 10th of March 40 units of inventory item is sold, since under FIFO method, it is assumed that when inventories are sold or used in a production process, the oldest are sold or used first. In the illustration, you can find that how cost of 40 units sold is computed. First cost of 10 units comes from January 1st, then cost of 30 units are from the 18th of January purchase. Further you may take note that, cost of remaining inventory as on the 10th of March also computed as per FIFO method. Next, cost of inventory formula, illustration of weighted average cost method. Here in the screen you can see the data related to an inventory item, its opening balance, purchase and sales of etc. at various dates. It is the same data we have used, in previous slide, for the computation of cost of inventory under FIFO method. The weighted average method, which like FIFO is suitable where inventory units are identical or nearly identical, involves the computation of an average unit cost by dividing the total cost of units by the number of units. The average unit cost then has to be revised with every receipt of inventory, or alternatively at the end of predetermined periods. Here in the illustration, we have computed weighted average cost is computed with every receipt of inventory. You can see that at each purchase, weighted average cost of inventory item is changed, and subsequently, cost of sale is computed based on prevailing weighted average cost. Net realizable value. IAS2 states that inventories shall be measured at the lower of cost and net realizable value. In earlier slides, in section of definition of important terminology in IAS2, we learned how to compute net realizable value. Net realizable value is the estimated selling price in the ordinary course of business less the estimated costs of completion and the estimated costs necessary to make the sale. The cost of inventories may not be recoverable if those inventories are damaged, if they have become wholly or partially obsolete, or if their selling prices have declined. The cost of inventories may also not be recoverable if the estimated costs of completion or the estimated costs to be incurred to make the sale have increased. The practice of writing inventories down below cost to net realizable value is consistent with the view that assets should not be carried in excess of amounts expected to be realized from their sale or use. Any write-down to net realizable value should be recognized as an expense in the period in which the write-down occurs. Accounting entries for write-down of inventories. Debit, cost of goods sold or inventory write-down expense account, a P&L account. Credit, inventory allowance account. Reversal of inventory write-down. A new assessment is made of net realizable value in each subsequent period. When the circumstances that previously caused inventories to be written down below cost no longer exist or when there is clear evidence of an increase in net realizable value because of changed economic circumstances, the amount of the write-down is reversed, that is, the reversal is limited to the amount of the original write-down, so that the new carrying amount is the lower of the cost and the revised net realizable value. This occurs, for example, when an item of inventory that is carried at net realizable value, because its selling price has declined, is still on hand in a subsequent period and its selling price has increased. Any reversal should be recognized in the income statement in the period in which the reversal occurs. Accounting entries for reversal of write-down of inventory. Debit, inventory allowance account. Credit, cost of goods sold account or inventory write-down reversal account, a P&L account. Lower of cost and net realizable value, how inventory value presented in balance sheet and illustration. As we learned that according to IAS2, inventory shall be measured at the lower of cost and net realizable value. An assessment is made of net realizable value of inventory in each reporting period. Now, let us look into an illustration. For better understanding, inventory value measured at lower of cost and net realizable value in real-world situation. In the screen you can see data of inventory at the hand of Messrs. Sunshine Company at end of reporting period. You can see that item per unit cost, that is raw material cost plus overhead cost, cost to sell and sales price etc. has given for item A and item B. Please find what should be the inventory value Messrs. Sunshine Company should present in its balance sheet at the end of reporting period. Now, please note in the screen the statement of inventory value computed for presentation by Messrs. Sunshine Company at end of reporting period. A quick recap: net realizable value is the estimated selling price in the ordinary course of business less the estimated costs of completion and the estimated costs necessary to make the sale. According to IAS2, inventory shall be measured at the lower of cost and net realizable value. An assessment is made of net realizable value of inventory in each reporting period. As you can see in the statement in the screen. For item A, net realizable value is lower than cost, therefore, inventory cost is written down to net realizable value and at the end of the period. Then, item A inventory value is presented in balance sheet which is equal to net realizable value. For item B, net realizable value is higher than cost, therefore, at the end of the period, item B inventory value presented in its balance sheet is equal to cost, as it is lower 1. Recognition of inventory cost as an expense. When inventories are sold, the carrying amount of those inventories shall be recognized as an expense in the period in which the related revenue is recognized. Accounting entry. Debit, cost of goods sold account. Credit, inventory account. Further, it is relevant to note that the amount of any write-down of inventories to net realizable value and all losses of inventories shall be recognized as an expense in the period the write-down or loss occurs. The amount of any reversal of any write-down of inventories, arising from an increase in net realizable value, shall be recognized as a reduction in the amount of inventories recognized as an expense in the period in which the reversal occurs. Some inventories may be allocated to other asset accounts, for example, inventory used as a component of self-constructed property, plant, or equipment. Inventories allocated to another asset in this way are recognized as an expense during the useful life of that asset. Inventory-related disclosure in the financial reports. The financial statements shall disclose the following information related to inventory. 1. The accounting policies adopted in measuring inventories, including the cost formula used. 2. The total carrying amount of inventories and the carrying amount in classifications appropriate to the entity statement users. Example of common classifications of inventories are merchandise, production supplies, materials, work in progress and finished goods. 3. The carrying amount of inventories carried at fair value less costs to sell. 4. The amount of inventories recognized as an expense during the period. 5. The amount of any write-down of inventories recognized as an expense in the period. 6. The amount of any reversal of any write-down that is recognized as a reduction in the amount of inventories recognized as expense in the period. 7. The circumstances or events that led to the reversal of a write-down of inventories, and 8. The carrying amount of inventories pledged as security for liabilities. In case entities adopt a format for profit or loss that results in amounts being disclosed other than the cost of inventories recognized as an expense during the period. Under this format, that entity presents an analysis of expenses using a classification based on the nature of expenses. In this case, the entity discloses the costs recognized as an expense for raw materials and consumables, labor costs and other costs together with the amount of the net change in inventories for the period. This is end of this video on IAS2 inventories. Thank you for watching. See you next time with another video on International Financial Reporting Standards.